All right, let's talk about something we all love to put off, life insurance. But hang on, before you click away, I promise this isn't going to be morbid or complicated. We're going to reframe this. This isn't about death, it's about money, it's about math, and it's a super smart financial strategy that's way easier than you probably think.
So, let's just get right to it with the tough question. Seriously, think about this for a second. If you weren't here tomorrow, could your family actually keep their home? Could they pay the mortgage, the bills, put food on the table? Being honest with yourself on that one, well, that's the first step. It's why this whole thing is so critical.
Look, I get it. We all get it. Life insurance just feels heavy, right? It's complicated, it's a bit of a downer, and it is, hands down, the ultimate procrastination topic. But that's exactly what we're going to fix today. Our goal is to just strip away all that complexity and hand you a simple, really powerful toolkit to make sure your family is protected.
Okay, so here's our game plan. First, we'll tackle that procrastination problem head-on. Then, we'll talk about renting your financial shield. It's a game changer. We'll look at the bell curve of need, calculate your exact number, check out some smarter strategies, and then wrap up with your clear path to protection. Let's do it.
All right, Section 1, the procrastination problem. And here's the big reframe I was talking about. This is not about death. It's about money, math, and strategy. You know, it all boils down to one simple question. If the absolute worst happens, how do you make sure that the only thing your family loses is you, and not their home, not their education, not their entire future?
So, how do we make this whole topic simple? Well, it comes down to one core analogy that honestly changes everything. We're going to introduce the idea of renting your financial shield. Let's just toss out all that confusing insurance jargon and think about it in a way we all understand. Renting versus buying.
Okay, now this is where we kind of flip our usual financial script. You've got whole life insurance over here. Think of that like buying a house. Yeah, it's permanent, it builds some cash value, but man, is it expensive. Then you have term life insurance. This is like renting an apartment. It's pure protection for a specific amount of time, and here's the kicker, it's super low cost. You're getting a massive financial safety net for a small monthly payment. It's a totally different ballgame.
So what exactly is term life insurance? It's really just a simple contract, a promise. You pay a monthly premium for a set period, say 20 years. If you pass away during that term, boom, your family receives a huge lump sum payment. And this is a big deal. Here in Canada, that money is completely 100% tax-free. Now, this is the part where a lot of people get stuck. They think, wait, if I outlive the policy, I don't get my money back? And that's true. But think about it like this. It's like your Netflix subscription. You're paying for access to protection, not to own the movie. You wouldn't call Netflix after 10 years and ask for a refund because you didn't watch every single show, right? Of course not. You paid for the access, the peace of mind. It's the exact same idea here. Okay, so if it's only temporary, why does it make so much sense? Well, here's the secret. Your need for life insurance isn't permanent either. It's not this flat line that goes on forever. It's actually a bell curve. This is why temporary protection can make permanent sense. Just think about your own life, right? When you're, say, 35, your risk is through the roof. You've got a massive mortgage, little kids running around, and your savings account, well, it's just getting started. But fast forward to age 65. The mortgage is paid off, the kids are independent, your savings are now substantial. You've essentially become self-insured. Term insurance is just the bridge. It's the financial shield that gets you safely from that high-risk side to the low-risk side.
So the strategy becomes incredibly simple. All you have to do is match the term, the length of the policy, to your biggest, longest financial obligation. Got a brand new 25-year mortgage? A 25-year term policy is a no-brainer. Just had a baby and want to make sure they're covered until they're independent? A 20-year term lines up perfectly for that. See? It's just common sense.
Okay, awesome. So we know why we need it. But the next big question is, for how much? You hear these rules of thumb, like get 10 times your income. But honestly, that's just a guess. We can do way better than that. We can get precise. And we're going to do it with a super simple formula called the DIME method.
This little acronym covers the 4 main pillars of what your family would lose. So D is for debt. That's everything except the mortgage. Think credit cards, car loans, that kind of stuff. I is for income. How many years of your income would your family need to replace? M is for mortgage, the big one. The goal here is to wipe it out completely. And finally, E is for education. You want to make sure the kids' college or university funds are taken care of.
You just add those 4 things up and boom, that's your number. No more guesswork.
And listen up, because this is probably the single biggest mistake that families make. They forget to ensure the economic value of a stay-at-home parent. Think about it. If that person is suddenly gone, you are now paying out of pocket for childcare, for cleaning, for cooking, for managing the entire household. That replacement cost is huge, somewhere between $250,000 and $400,000. It is absolutely crucial to ensure that value.
All right, now for those of you who want to take this to the next level, let's dive into some smarter insurance strategies. These are a couple of ways you can really optimize your coverage and, get this, save a ton of money over the long haul.
This first one is a really brilliant strategy called laddering. Here's the idea. Instead of buying one single massive policy for 30 years, you stack multiple smaller policies with different expiration dates. Why? Because this lets your coverage amount step down over time, perfectly matching that bell curve of need we talked about. It's super efficient.
Let me show you how this works. Let's say you need $1 million of coverage right now. Instead of buying $1 million policy, you buy 3 smaller ones. Maybe a 10-year policy for $300,000, a 20-year for $400,000, and a 30-year for another $300,000. For those first 10 years, all 3 policies are running. Add them up, and you've got your full $1 million in coverage, right when you need it most.
But then, check this out. After year 10, that first short-term policy just expires. It falls off. So now your total coverage drops to $700,000. And this is perfect because by now, your needs have probably dropped. The kids are older, you've paid down the mortgage a bit, and here's the best part. Because a policy dropped off, your monthly premium goes down too. You are only ever paying for exactly what you need right when you need it. It's so smart.
Okay, last thing in this section. There are these little add-ons called riders, and there are 2 that are pretty much non-negotiable. First is the waiver of premium. This just means if you become seriously disabled and can't work, the insurance company pays your premiums for you so your coverage stays active. The second is the conversion privilege. This is your get-out-of-jail-free card. It lets you convert your term policy into a permanent one later on with no medical exam. So if your health changes for the worse, you're still covered. You've got to have these.
Phew, okay. We have covered a ton of ground. So let's bring it all home. We're going to boil this down to your key takeaways and figure out exactly what your next step should be. This is your path to protection.
All right, here is your action plan. It's simple. Number 1, change your thinking. You're renting a financial shield, you're not buying an asset. 2, calculate your actual need with the DIMI method. No more guessing. 3, match your policy's term to your longest liability, probably your mortgage. 4, think about laddering to save money over the long haul. But honestly, the most important thing on this list? Don't procrastinate. Lock in your rate while you are young and healthy. It will never, ever be cheaper than it is today.
You know, a lot of the smart strategies we've gone over, especially that laddering technique, are insights from the experts at Munera's Financial Services. If you're thinking, okay, this makes sense, but I'd love to talk to a pro, we've put their info right here. You can reach out directly to their specialist, Mansoor, to build the plan that's tailored just for you.
So let's just end with this one final thought, this one last reframe. Getting life insurance, it's not about betting on your death. It's about betting on their life. It's the one plan you put in place that guarantees no matter what happens to you, their dreams, their home, their future, it's all secure. And man, that is a powerful, powerful peace of mind.